just to set the stage for viewers, last week Fed Chair Jay Powell said during his press conference that there's a lot of division within the committee about whether they want to cut rates again in December. He said it's not a foregone conclusion. In fact, quote, far from it. He said now that the Fed has cut 2 times in a row, there's a feeling that they're 150 basis points closer to neutral on the Fed funds rate. That's a level designed to neither spur nor slow economic growth. And that there is a growing chorus on the committee that says perhaps we should wait. Well, Friday, we got some of that chorus colored in. Cleveland Fed President Beth Hammack said that she would have preferred to have held rates steady last week. She has more concerns about inflation than the employment side of the dual mandate. She says she's hearing more about inflation concerns in her district and that they're closer, she believes, to her estimate of neutral. And so she seems to be in favor of holding rates in December as well. We also heard from Lori Logan of the Dallas Fed, who said that cutting interest rates was not what was called for given inflation. She doesn't think that the Fed needs to take preemptive action to cut rates again in December at this point. Atlanta Fed President Raphael Bostic said he was convinced to cut interest rates, but warned that the Fed needs to be very careful going forward about cutting rates further because inflation remains well above the Fed's 2% target. We also heard from Kansas City Fed President Jeff Schmidt, who we know dissented because he preferred to hold interest rates steady last week. And he was out with a statement essentially saying that he thinks that cutting rates further could ignite inflation. On the flip side, Fed Governor Chris Waller was in favor of cutting rates, voted to cut in favor of rates, I should say, last week, and said it poured cold water on Fed Chair Jay Powell's analogy of driving through the fog and needing to slow down. He believes that the Fed does have enough data here right now and that they should cut again in December. You had said before the policy meeting that you were somewhat uneasy about front-loading rate cuts based solely on slowing payroll growth, and that at the same time, inflation had been moving in the wrong direction, and just counting on inflation to be transitory made you uneasy. So why did you vote in favor of cutting rates last week? Was there anything that changed that caused you to want to take out more insurance?
Well, before the last meeting, not this November meeting, but in September, we issue the statement of economic projections, our dot plot projections of where the economy is going to be and where rates are going to be. And at that time, I thought there would be 2 rate cuts for the year. I'm balancing off 2 things. One, as you know, I believe that the place rates will ultimately settle is a fair bit below where we are today. And as long as we can get the dust out of the air, I still think that golden path is possible. And I'm trying to weigh that off with these concerns about front loading, especially when we have the data shut down. We're getting some information about the job market, and we have very little private sector information about inflation. So I think we want to be wary, but I'm still just trying to balance those off. Not much change since the September SEPs. And so I had no problem with that.
So, Austan, you're saying you're trying to sort of look through all this dust, waiting for it to settle. You had penciled in 2 rate cuts for this year, and Chair Powell had said after the policy meeting last week during his press conference that there's a feeling that you've cut twice and you're now 150 basis points closer to neutral than you were a year ago, and that there is a growing chorus on the committee that perhaps maybe you should wait. Are you one of the chorus?
I'm not supposed to say anything about what other folks say. In my mind, as you know, I am uneasy with front-loading rate cuts. I do believe rates will come down, but in a way, rates should come down with inflation. We've got to, if we're just going to count on the inflation that we've seen here, where the last 3 months core inflation is running 3.6% at an annualized rate, and core services, I think, are running close to 4% as annualized rate for the last 3 months. That's worrying because that's going the wrong way. If we're just counting on that to go away because it's transitory, that makes me uneasy. So I'm not decided for what I think about the next meeting, and we are still going to get at least some private sector observations and the Chicago Fed's labor market indicators telling us some about the job market. We're probably not going to get much on the inflation side, so I am a little wary, and my threshold for cutting is a little bit higher than it was in the last two meetings.
So to your point, Fed Chair Powell used the analogy of when it's foggy, you want to slow down, become a little bit more cautious. Is that a fair characterization for you? And how are you viewing the balance of risks, fully recognizing that we haven't had official data on the labor market side because of the government shutdown? It sounds like you may be more worried about inflation than employment now when you look at the balance of risks.
I've been a little more worried about inflation than the job market if you think of it as a balance of risk, for the reason that other than payroll job growth, if you look at things like the unemployment rate or other rates that are less affected by population changes or immigration policy, those things have been pretty stable for some time. If you look over the last 12 months, the unemployment rate has not been going up. We haven't seen a big uptick in layoffs, which if this were the beginning of recession or deterioration of the labor market that was rapid, you would expect to see higher layoffs or firing, and we haven't seen that. There's still concerns on that side. And as you say, we're going to get some private sector data, so we can at least keep observing that. But I just want to emphasize, be very careful at moments of transition where you're trying to figure out whether the economy is turning, relying too heavily on 12-month backward-looking numbers like the 12-month trailing inflation. Each month we get a number, and 11 of the months we already knew. The new information is only for that new month. So the fact that the last 3 months inflation is not going down but is instead going up, including in some categories that are not driven by tariffs like services, those are areas of concern. And so that's a little bit, the last time you looked out the window, there was a mountain lion sitting in your front yard. So before you let Fluffy out to go run around, let's at least get one more look.
All right, well, aside from Fluffy, I do want to come back to the job market because, yes, payroll growth did slow over the summer months, and since then you sort of have been in the dark as far as official data. But last week we saw some major layoff announcements from the likes of Amazon to UPS. If you did look at private sector data, ADP's measure turned negative for the month of September. We're going to get another measure this coming Wednesday. And the Beige Book revealed that employers are looking at cutting headcount either through attrition or layoffs due to policy uncertainty, weaker demand, and AI. Does that not worry you? Do you think that perhaps payroll growth has decelerated further since you have gotten official data?
It might have, and that's why, as I say, I'm not decided going into the next meeting. I want to see how things are playing out. I do think the public announcements of layoffs, you would expect, if that is an immediate business cycle driven matter, that you would start to see an uptick in the official unemployment insurance statistics or the layoff statistics, or you would get Warren Act type data of that form that would give you a little bit of a heads up of what was coming in the job market. I do think the hiring rate is low. That's among the weakest things in the economy at the moment, and that's made it particularly tough for new graduates and young people. But a low hiring, low firing economy is unusual. That's the kind of economy that you expect when there's a lot of uncertainty. Normally, in the business cycle, you would have low hiring, high firing, or low firing, high hiring. when you get uncertainty, both of those go up as people kind of pull back and say they want to wait to see how things are going before they make decisions. This whole second part of what's going on in the job market, if it is being driven by AI, if it is concentrated in the tech sector, that doesn't feel as much like the business cycle to me and economic stabilization. That feels like more of a structural shift in what sectors are going to be employing people. So we have to think through, what does that imply for monetary policy? That's a little different than if you were afraid that we were going into recession.
Yeah, so to your point, what is all of this telling you about the outlook for the economy in a cyclical sense, right? Not a structural sense, because that is what you have control over at the Federal Reserve. Perhaps are we at a turning point in the economy, given what we're seeing in private sector job market data that GDP data is not yet reflecting?
Yeah, look, I always say one of the hardest things the central bank ever has to do is get the timing right on moments of transition. And that's especially difficult if you have squished bugs covering the windshield and you can't see whether you're still on the road. And when they shut down the data, the official data, that's the circumstance we're in. So I don't know that it's decided. I'm not decided going into the December meeting. I am nervous about the inflation side of the ledger, where you've seen inflation above the target for 4.5 years, and it's trending the wrong way. I believe on the other side, rates can come down a fair amount. It would probably be most judicious to have the rates come down with inflation. So let's get some observations that document that inflation is coming down and that the uptick we've seen is transitory. But we've got to weigh that off. If the job market starts to deteriorate in a more significant way, then that would change the balance of risk.
And Treasury Secretary Scott Bessent said yesterday that he believes that parts of our economy, particularly housing, may be in a recession already. Sounds like you may disagree with that. What are your thoughts on that?
Well, I think he's right that the housing construction sector's been weak. It has been weak now for some time. The three most interest rate sensitive parts of the economy usually that give you a sense of the business cycle are housing, consumer durables, and business investment. I think he's right to highlight housing's been weak. Consumer durables have been pretty resilient. And you saw, as you said, the GDP numbers coming in and consumer spending coming in pretty solid. And business investment has been kind of off the chain. Now, much of that driven by the AI boom, so that might not be cyclical, but the interest rate sensitive parts of the economy don't feel like they overwhelmingly point to that we're in a slowdown. I think that the economy has been pretty strong. The economy is pretty solid and has been. There's weakness in sectors, and anybody who's dependent on intermediate goods that the tariffs are applying to has been suffering. But other parts of the economy continue to grow, and overall consumer spending remains the main driver of solidity. Is that of the solidness of the economy has been largely based on consumer confidence.
Well, Austan, unfortunately, we're out of time. We'll have to leave the conversation there. Always so many more questions for you. So appreciate your time and insight this morning. Hope you'll come back and see us soon.
Yeah, anytime, Jennifer. Thank you for having me.
It's almost remarkable to me the extent to which there is still a pricing in that there will be a cut in December. Do you think it'll happen?
Yeah, I think it will happen. But listen, one thing I've learned about markets is you have to interpret what they are saying. There is a part of this committee that definitely would like to wait and evaluate the data. I think they can go. I think they should go. I think they can go quicker. But I respect the fact that inflation is running a little higher. I would argue, you're still, if you take 6 months core PCE, you're running at about 2.5%. Other metrics, you're running closer to 3%. My only view being that's not an infectious inflationary expectation dynamic that allows the Fed to move. In fact, in the market today, you can buy 5-year inflation break-evens at 2.5%. It's not like the market thinks inflation is a problem, such that I think the window is there. I have a stronger view that I think labor is a tricky thing from here, and I think there is significant displacement on labor that we're going to see over the next couple of years. Last week being an embodiment of that when we heard from Amazon, UPS. Technology is changing the world. I mean, I was on a call with the CEO today, and we're talking about data center investment. When you go into data centers, you don't see a lot of people. You see a huge amount of CapEx. So it buoys the economy. You just don't see a lot of people in those facilities.
No, although you have to build them, right? You have to build them, you have to outfit them. That all requires people. But then when they're done, to your point, there's nobody there.
That's right. And by the way, it's not just AI that's creating this productivity. You talk about things around inventory management, logistics, client procurement, predictive maintenance. I mean, productivity is exploding everywhere. It means you see it in all the corporate earnings. Companies are doing well, the revenues are decent, cost of goods sold is coming down, their SG&A is coming down. You can operate with a lower cost threshold. That's why you're seeing M&A that's so high. I got to get bigger, I got to vertically integrate, I got to use data, I've got to use AI, and I don't need as much fixed infrastructure, including people.
So this so-called low hiring, low firing environment that we keep talking about, has that already changed? Are we just not seeing it in the data yet, but we have the anecdotal evidence?
So, listen, there's no doubt that is the best characterization of where we are from a labor perspective today. My sense is companies are waiting, and you're seeing, I think today, I talked to CEOs who tell you, I'm comfortable with my labor force today. You saw Walmart freeze hiring. Let's stay where we are. Let's see if we can grow our business. And then you'll see some companies that proactively will reduce labor. I think, so if you take the last 4 months of data that we have gotten, and I don't think it's going to change much. The data we think is going to come is going to show the same thing. The last 4 months, if you strip out healthcare is not cyclical, it's not interest rate sensitive. We have negative job growth. I think that is something that is going to be persistent. Hopefully, the economy continues to be resilient, which I think it will. Actually, the economy's in good shape. I think the economy's in good shape, companies are in great shape. I think labor, not so much.
Okay, so here's the question then. So say the Fed cuts because they're concerned about the labor market. What does that do for the labor market? How does it help the labor market?
So there's a few things. By the way, you brought up the most salient issue. So by the way, what is the interest rate effect today? In inflation, you think about what's sticky inflation? Healthcare, insurance, education, pretty hard to get interest rates to help healthcare, insurance, education. Shelter is actually one that you can help. You bring the rate down, you help inflation.
But shelter's not the one that's the problem as much right now. As Austan just pointed out, it's the services inflation right now that's accelerating a little bit.
Those are the ones that are, but those are really,
stickier.
Right. But shelter is coming down. By the way, something you're starting to see is the mortgage rate has come down to around 6. All of a sudden, existing home sales are higher. You build more houses. You look at the earnings reports from the D.R. Hortons, the KB Homes, the Lennars. We're not building enough houses. Why? Because the home builders have to subsidize the mortgage rate. If you get that rate down, we'll get more housing. You'll bring down shelter. Listen, I think shelter is still the trickiest one. And what helps when you build more houses? Labor mobility. You lose your job in one state, I can move to another state. You create more velocity, and you can't AI building a house. Your point about data center.
Right.
If we can put a lot of people to work, there are so many reasons for doing it. Point being, listen, the interest rate tool today doesn't really affect CapEx because who's spending on CapEx? The big hyperscalers, et cetera. They fund through free cash flow.
And they also have a fiscal tailwind. I mean, not just AI, but in general,
Totally.
There's a fiscal tailwind for CapEx.
Totally. So it's not really, interest rate doesn't really affect CapEx like it used to in the 70s and 80s. Now, what is the interest rate affecting? Small business, 44% of the hiring in the United States. By the way, slowing, having a tough time. We need to help small business. Low income that borrows on their credit card, borrows student loan, borrows through other mechanisms. That is hurting. Housing is hurting. And by the way, the US government, 90% of what we finance in treasuries is 2 years and in. You keep the interest rate 100 basis points above where it should be, and that costs the country $100 billion per annum. So point being, the interest rate tool is not like it was in years ago when it was the calibrator, it was the modulator of growth in the economy. It affects the people that are getting hurt today, and it doesn't really do much for CapEx.
And so you think they will cut in December as a result of all of this reasoning?
I do.
We talked about a year ago at our big Invest conference, And then I quoted you for months afterwards because at that. But what's so fascinating to me is how much the world has changed since then. Because at that time we were talking a lot about the deficit and how concerned some corners of the market were. But if you remember, you said it's not the shark closest to the boat. It is not the most immediate threat. And in fact, that threat has seemed to recede even more between now and then. Do you think that is, what do you think is the shark closest to the boat? And do you think it's okay that we're not as worried about the deficits right now?
So, I think I said it then, and I'll say it today. I think the amount of debt we have in the country is still a tail risk, but I think it is only a tail risk. We have to keep refinancing. By the way, the fact that 90% of our debt, 89% exactly, is 2 years in, we got to keep rolling immense amounts of debt. That is still the tail risk today. I haven't gone through too many crises in my life, from the housing crisis to emerging market crises, European crisis, financial crisis. It all centers around where the vulnerabilities are, and that's the debt. Today it's at the U.S. government. Listen, I think there are a lot of things happening that allow us, as long as the economy grows, and this is part of my thesis around, we got to run the economy with 5% nominal GDP. I think we'll hit it this year. I think there's a good chance we'll hit it next year. If you keep nominal GDP over the cost of the debt, meaning we get the cost of the debt down a bit, we keep nominal GDP, we'll actually de-lever the economy. So it is still the risk that's out there. Assuming the economy grows and we get the cost of the debt down, we'll be okay.
What is the biggest risk then?
So away from that, I'd say complacency. And when I see in markets, you start to see some things. There's a lot of money in the system. Part of why the equity market, I think, will keep going up. The technicals are extraordinary. People are willing to do things to generate return. That to me is out there. And then I don't see a lot. I feel good about the U.S. economy. The only problem with the economy is it's bifurcated. It's the most bifurcated economy I've ever seen. You got working a couple of cylinders on CapEx, a couple of cylinders, high income spending, low income not. So anyway, I think the economy's okay. Geopolitics hopefully is stable. U.S.-China relationship hopefully is stable. To me, it's just complacency and people putting money to work.
Well, and you said maybe going out the risk spectrum a little bit. You didn't say the word bubble, but I'll say the word bubble because it's been uttered by almost everybody lately. Is that... are we looking at that level of speculative behavior, do you think?
When I say no, the big companies today, the ROE these companies are throwing off. I actually went through the earnings that came out last week, and I was looking at the free cash flow that these companies are throwing off. It's like nothing I've ever seen. If you take free cash flow, just the companies, it was a Google, Meta, Microsoft, and you look at the amount of, not just revenues, not just cash flow, free cash flow after you've spent on CapEx, they're creating major companies every quarter. And then the multiple, you look at they're trading at 20, 25, 26 times earnings. Now, I see a lot of deals, particularly in the private markets, that are no cash flow, no revenue for the next 2 or 3 years. And by the way, some are good business models. My guess is most of them will fall away, similar to what you saw in the actual bubble back in 2000, when you didn't have any cash flow, you certainly didn't have any revenues. So I do see some of that in the private markets, but generally in the public markets, I don't think it's overdone.
Are the private credit markets? Let's leave aside the sort of tricolor first brands situations that we saw. Elsewhere, do you think there are problems in private credit? From a systemic point of view, no. We do a load of financing in real estate, commercial, resi, bilateral credit, bilateral finance. Generally not. I will say things that get auctioned off. Like whenever there's a big financing that gets auctioned off, or somebody wants to put their name on something that gets auctioned, like I look at the levels, sometimes it's through the public markets and think, why would you ever do that? There is some stuff, and they're around the edges in like financing software. What's going to happen with software and AI? There's some stuff around the edges that I think are tricky, but not a systemic, like we saw in prior decades. All right, Rick, I got to end with this. You are reportedly on the short list to be the next Federal Reserve Chair. I know you can't say very much about it, so I would ask it this way. Is that a job that somebody can say no to if they are offered it?
I'd say being on a list is an unbelievable honor for me, and everybody, will evaluate it based on, their own particular thought process. Listen, it's a huge honor, and I'm going to go through my process, and I will say today, the investing side of what we're doing is, you were kind enough. We did this ETF called BINC. I mean, the amount's up to $14 billion, and that's pretty incredible. There's some fun things to do in the investment arena. So, anyway, I know it's not a great answer, but that's where I'm gonna
enjoying what
focus.
you're doing right now, is what you're saying.
I am.
Okay. Good to know, Rick. We'll keep talking, I'm sure.
Thanks, Julie.
Thanks for coming in. I
Yeah,
really
I
appreciate it.
Governor Miran, thank you so much for sitting down with me. It was great to have you on the program.
Thanks for having me.
We've gotten a new reading this morning on private sector job growth, and we're seeing that job growth swung positive in October to 42,000 from negative 29,000. A lot of that job growth coming from larger companies as opposed to mid-sized and smaller companies. How are you looking at this report? And given that we don't have official government data, how is it informing your outlook for the labor market?
Sure. So, we always have to be cautious about reading too much into any one report, and that's going to be even more the case when we have a government shutdown, that we're not getting the data that we need to make monetary policy. Now, we are getting alternative data from a variety of sources, like the data that we got this morning from ADP, which is a welcome surprise that it came in a little bit better than expected. But in the context of the overall picture of the job market, it seems like the pre-existing trends that were in place before the government shutdown, the labor market, seem to be continuing, at a similar rate. You continue to see, modest potential overall job creation. You continue to see moderation in wages, and you continue to see indications that labor demand may not be as strong as we'd like it to be from a cyclical perspective. All of that, to me, is an indication that that rates could be a little bit lower than where they are now.
How much of this that's driving the job market right now is structural versus cyclical? We know there have been major policy changes that have come from the administration, which take time to work through the economy. What's your sense of that? And do you have the tools, if it is structural, to deal with that?
Yeah, so a lot of the changes to the number of job creation, to the levels of job creation that would occur as a result of policy changes like immigration are what we as economists would call output gap neutral, right? Economically, the role of monetary policy is to balance supply and demand in the economy, and to make sure that you don't have demand so far outstripping supply that you get, upward spikes in inflation, or that demand isn't cratering relative to supply so that you get downward spikes of deflation of the type that you have in a depression-like environment. And so the goal of monetary policy is really to balance supply and demand. Now, if you have changes in, let's say, population growth because you either have a policy of large-scale mass immigration or you have a policy of closed borders and net zero migration, that's going to be what we would think of as typically, in my opinion, output gap neutral. And the reason that's the case is that when you have an additional person in the economy, they're generally consuming as well. They're working and they're consuming. And so from an output gap perspective, it's not clear that there's a very big role for monetary policy to play, because it's not the case that supply or demand are moving by very different amounts. They could be moving by very similar amounts. And so some of the low levels of growth are a result of changing border policy. If you have an economy in which you're throwing in large numbers of new migrants, of course, the overall job number will be flattered by that. And if you stop that, the overall job number will reflect stopping that. But that's not necessarily something that monetary policy responds to automatically.
And sort of building on that, the president has gotten many companies to invest billions of dollars in this country. We're going to be seeing investments in technology, in AI, in factories at the same time. The tax bill has been made law. We've got 100% expensing on PP&E and factories. How much job growth could we see from that? And what is the timeline on that? Is that a 2026 story? And again, kind of going back to those longer term structural versus cyclical trends, how are you viewing that as it relates to the labor market and setting policy?
Yeah, so look, I do believe that the supply side of the economy matters, right? I don't exclusively look at either just the supply side or the demand side. I think that they both matter. And as I said a moment ago, the role of monetary policy is to balance them. And I think that there's a whole slate of expansionary policies on the supply side that drive out the productive capacity of the economy. You mentioned some of them, things like the full expensing provisions from the tax bill that was passed over the summer. There's now a huge tax incentive to invest in new factory equipment or to invest in factory structures. I do expect that to result in some additional investment demand. That additional investment demand pushes demand up higher in the short run, and a little bit longer run, it pushes the supply side of the economy out because you can produce more because you have more capital. And that's all stuff that matters when you think about the outlook and when you think about where monetary policy should be. But there's there's other elements that are pushing out the supply side too. And think about regulations. Regulations really shape the structure of the economy because they decide whether you can produce or not and what you can produce or not. So the industries that you have in the country, how big the industries are and where they're located, can all be a function of the regulatory environment. And as you change those, you can change the supply side of the economy too. And pushing out the supply side of the economy in those ways, and sometimes it'll take demand with it, for instance, and when the full expensing, right, will create investment demand. But in other things like regulations, it's not as clear to me that it pushes out the demand side as well, and it actually expands those output gaps that I mentioned a moment ago that monetary policy should respond to. So I think there's a variety of policies that are affecting the economy. They affect the short run, they affect the long run, they affect both of them, and they affect the supply side and the demand side. And it's really important to be thinking about the ways in which those are happening and trying to disentangle them and how monetary policy should respond to that. And we typically think about monetary policy as responding to three things. It responds to the output gap that we talked about. It responds to the outlook for inflation, which can also be affected by these policies, and it responds to changes in the so-called neutral rate. That's the level of monetary policy that's neither restricted nor accommodative. And so you'd want to be looking at all of these policies and trying to say, okay, what's it doing to each of those three things?
Switching gears, the Supreme Court is hearing oral arguments this morning about whether President Trump had the authority to issue tariffs under emergency economic powers. Under those powers, we've seen many trade deals cemented. The U.S. has pulled in nearly $200 billion in tariff revenue as of September 30th, 2025. If the High Court were to rule that issuing tariffs under those authorities were illegal, and I fully recognize that the administration is working on contingency plans, but what would that mean for the impact on the economy? Would that increase uncertainty, pressuring growth and hiring?
Yeah, so absolutely, something that would affect uncertainty would something that would increase uncertainty over the tariff environment, over the trade environment, is absolutely something that could be a drag on the economy, and that might come as a result of the deliberations you referenced. That type of drag on the economy normally would, all else equal, depending on how the Fed is doing on hitting its two mandates of price stability and maximum employment, but all else equal, in addition of uncertainty from something like that, is something that you would think of us as normally offsetting with moderately looser interest rates. And there's been other sources introducing trade uncertainty in the recent past too. We recently just had another little trade confrontation with China that resolved favorably for the short run, but we'll have to see sort of the durability of something like that as well. But also, the revenues that the revenues that you mentioned matter because the amount of savings in the economy sort of ties back to monetary policy for thinking about where we set interest rates. And if you have an increase in national savings, it normally is the type of thing that would lead to lower interest rates, along lines that I discussed in a recent speech of mine that I gave a little bit over a month ago. And if that revenue were to go away, then you would sort of naturally think that would have implications for interest rates that would be of importance to monetary policy.
You dissented for the second policy meeting in a row last week, preferring to having cut by 50 basis points instead of 25 basis points. You said you don't think that tariffs are leading to higher inflation, and you'd like to get to a level of neutral on the Fed funds rate faster than your colleagues so as not to do undue harm to the job market.
Yeah.
Are the economy and the labor market at risk given the pace with which the Federal Reserve is proceeding at this point?
So, look, if you look at the summary of economic projections, I think that that most of my forecasts are not really, or most of my projections for where the economy and inflation will go and the appropriate policy that would reflect those, are not that different from, I think, where a lot of the rest of the committee is. The significant difference is that I want to get there faster than everybody else does. It's not that the destination is really all that different. It's that the speed with which I want to get there. And part of the speed with which I want to get there is a result of the inflation outlook. I'm more sanguine on the inflation outlook than a lot of my colleagues are, in particular because I don't view tariffs as driving a material amount of inflation, but also because I see shelter and housing market inflation coming down more quickly than many of my colleagues do. That said, to your question, I think policy is too restrictive and that we're too far above where neutral rates would be. And given the state of the labor market, I think that continuing to run policy that restrictive is to also run unnecessary risks. And there are lags with this monetary policy. It's the economy. If policy is that restrictive, the economy doesn't crater immediately. However, if you keep policy that restrictive for a long period of time, you run increasing more and more risks that those lags catch up to you and that monetary policy hits the economy in a really unfavorable way.
To your point, Treasury Secretary Scott Bessent said over the weekend that he believes that there are parts of our economy, particularly housing, that may be in recession already right now because of high interest rates. Do you agree with that?
Well, I think there's always going to be parts of the economy that are relatively stronger or relatively weaker. That's always going to be the case. But we were tasked by the Congress with targeting maximum employment and stable prices in the economy as a whole. And so it's not really appropriate for us to sort of respond to a particular sector of the economy that may be in more or less distress than other sectors. We want to think about the economy as a whole. And I'll go back to what I said before. If we keep rates this restrictive for a long period of time, you increase the risk that the restrictive rates themselves, that is that monetary policy itself, is what causes a downturn in the labor market of exactly the type that we were tasked by the Congress with avoiding.
Chair Powell said that a December rate cut is not a foregone conclusion. In fact, far from it. And he stressed that there's a lot of division on the committee right now as it relates to risks as they view inflation and the job market. What's your sense from the meeting, again, your sense of whether it's going to be an uphill battle to convince your colleagues to cut again next month, let alone cut by 50 basis points?
Well, look, I speak for myself and not for anyone else. But, I think that if you go back and you look at the summary of economic projections that we put out after the September meeting, the median forecast was the median projection was for a third cut this year, meaning a cut in December. So I think the natural question that would follow from that is, has anything changed that would make you change the way that you think about the appropriate policy stance? And the new information that we've gotten since the September meeting, which is not as much as we would like because of the government shutdown, but the new information we've gotten has been, one, that inflation has actually come in below where expectations were for the September CPI print that came out recently. And two, that the labor market continues to be, based on the alternative data that we have, the labor market continues to be on the trend that it was. So given those two things, I would think that it would be consistent with the September summary of economic projections to increase the odds rather than decrease the odds. But that would be according to the median of those projections. And so if that were serious, then I would think that the odds would have gone up. And again, anything can happen between now and December. There could be new information. There could be surprises. There could be shocks. Things that we don't expect could occur. You've mentioned several possibilities. But barring new information that would make you really change your forecast a lot, I would think it would sort of still be a reasonable, consistent, a reasonable action consistent with that SEP to continue on the path that we've been on.
Let's talk about inflation, because the latest CPI report showed that housing inflation actually dropped, which goes to your point that as you expect lower immigration, that will push down demand for housing, bringing down overall inflation. However, services seemed to move sideways. Core services inflation has been running closer to 4% over the past 3 months. So how are you looking at that? Because that's not tariff related.
Yeah, so I viewed that inflation print as consistent with my expectations and as bolstering my case, because so much of my case does rest on housing coming down and shelter disinflation being enough to compensate for some higher run rates in other parts of the index. But that said, if you look at the non-shelter services, I think that it's important to sort of say, okay, what are these services? And the way that the Bureau of Economic Analysis calculates the price index on personal consumption expenditures contains some things that it might not be natural to think of monetary policy as targeting. And so we spoke before about how monetary policy balances supply and demand. And there are what we call imputed services in that PCE index. Things like financial services, like portfolio management fees. And the way that gets recorded in the data that the BEA constructs are that if the stock market moves higher, then portfolio managers, asset managers, so forth, they're collecting more fees on the assets they're managing because the value of the assets has gone up. That gets recorded as a price increase in the inflation data, even though you might think of it as more of a quantity increase. They're managing more assets, so therefore, they have a constant management fee. The volume of the assets moves up, and so the overall fee comes up because there's a higher base, but the management fee itself didn't really change. And yet that gets recorded as a price increase in the inflation data because of quirks of the statistical process. But it doesn't strike me that implies a supply-demand imbalance of the type that monetary policy should respond to. Monetary policy shouldn't mechanically respond to an increase in the stock market that could be driven by any number of things. It could be driven by a new technology, like AI. It could be driven by a government policy like removing regulations. It could be driven by any number of possible things that monetary policy might or might not want to respond to, but it shouldn't want to respond to it because of the stock market. Once you remove some of those imputed services like that, and you look at more of a market-based core services or market-based core PCE inflation, it's much closer to 2%. It's like 2.3, 2.4, depending how you slice it.
Before I let you go, Governor Miran, is there a line in the sand on inflation, whether it's CPI, PCE, inflationary environment, that would change the trajectory of getting to the rate of neutral that you see at 2.5%? Or is it that you're saying we should get to 2.5% as fast as possible, and if inflation is not coming down, then we adjust upwards?
Yeah, so as I've said in the past, shelter inflation is such an important part of my outlook for a couple of reasons. One, it's the biggest weight in the indices. Two, it's the biggest weight because it's the largest expense for most people is going to be their rent or their mortgage or whatever. And so, that goes into how people think about the cost of living and how people set their inflation expectations. The cost of housing is really important for people thinking about the cost of living. And my expectations for shelter inflation are extremely benign because market rents have been running at about 1% on a weighted average basis for several years now. And so it's only a matter of time until the official data converge down to the market data. And I think that process is underway, and the recent inflation print, I think, bolstered that view. Now, my view is that the shelter disinflation is enough to compensate for some higher inflation in other segments of the index. If something were to change that made me change my view of shelter disinflation to say, hey, there's a housing shortage again. Rents are moving much higher. The rent, there's going to be a huge increase in rents from where they are now. Rents have been relatively constant, running at a low 1% rate, and that low 1% rate is going to turn into 2, 3, 4%. Then my entire forecast needs to be updated as a result. And if my entire forecast needs to be updated as a result, then I need to change my policy outlook as well. So for me, a lot of my outlook is hinging on this. And if there were some piece of news or data that made me revise that, then I would make that revision, and I think that would sort of flow through my entire outlook into the policy projections as well.
Governor Miran, we'll have to leave the conversation there, but thank you so much for your insights. So appreciate it. Hope you'll come back and see us soon.
Of course. Thanks for having me.
In oral arguments yesterday about whether the president has legal authorities to issue tariffs under emergency economic powers, the Supreme Court justices seemed to express some skepticism about the administration's arguments, even some of the most conservative justices on the bench. What was your reaction to those arguments? Are the tariffs in danger?
Well, certainly the court asked a lot of questions, and the president has worked incredibly hard to address what clearly is an emergency situation with our trading partners as it relates to historically large deficits and also issues as it relates to national security. And the administration, as Secretary Bessent said yesterday, does believe that we've made a very powerful, compelling case. We do believe the court will rule in our favor, that the president has the ability to decide what an emergency is. As it relates to foreign policy, the historical record is clear. The president has that bandwidth. It is a signature legislation, so to speak, or one of his signature policy initiatives, along with the One Big Beautiful Bill. And historically, the Supreme Court acknowledges those sorts of things and does tend to agree with the administration on these issues. But again, we do believe the president has the authority, and we're hopeful that it will be resolved in a satisfactory way.
I know you just said, Joe, that you think the court will rule in the administration's favor. The president has called this case literally a, quote, life or death decision for our country. And certainly the tariffs have been the economic centerpiece of the president's economic agenda. What is at stake here if the high court were to knock this down?
The president said it the best. This is really would be an historic ruling if it was to go against the U.S. These tariffs. Look, Jennifer, the IEPA, the International Economic Emergency Powers Act, gives the president the authority to regulate imports. That means if he wanted, he could put an embargo on against a particular country to have none of those goods come in. A tariff effectively works the same way, but works in a more nuanced, more effective, more surgical way. And this policy, if it's reversed, is going to undo what the president wants to do in fixing the emergency, getting trade deficits down, being able to have more national security, which is interwoven with economic security in the U.S. And the IEPA is a key tool to do that. We won't be able to reindustrialize. We've got capital coming in. It's coming in because of the tariffs. We've got the One Big Beautiful Bill, which kept the Trump 2017 tariffs, taxes in place and tax policy in place. We've got cheap and abundant energy, business deregulation. So as you said, the tariffs are a centerpiece. The president's exactly correct. If the court mistakenly were to rule against us, that would cause unnecessary economic pain and hardship. We're hopeful it won't happen, and we'll see what happens.
Just to dig a little bit deeper on what you just said there, what type of economic pain could we see? I mean, yesterday I spoke with Federal Reserve Governor Stephen Miran, who said at the very least it would increase uncertainty and drag on economic growth. What supply chains, to your point, are being resituated as a result of these new lines that are being drawn by tariffs? We've collected nearly $200 billion in tariff revenue as of September 30th. If you could expound on what kind of economic ripples we could see as far as recession or not, please do.
Yeah, well, Governor Miran made some very good points. I completely agree with him on that. But even Justice Barrett talked about, well, how would you even give the money back? How would you give the refunds back? It's a very complex issue. There were some third-party providers that were responsible for collecting the tariffs. How would it work? How would you disperse those funds? Financial markets, which initially were nervous about these tariffs, they were nervous about President Trump's policies, have cheered those policies. Yes, so to the extent that the policy would be reversed or watered down, that would damage financial markets. It would damage confidence. The system, the economic system, capitalism works on confidence. You've seen record high equity markets. You've seen record low credit spreads. You've seen commitments by all different countries and companies to invest in the U.S. Everything works hand in hand with what President Trump's vision is to reindustrialize and rejuvenate the U.S. economy and build things again. So I'm an optimist. I don't want to think about, the worst case scenarios. The president has been very clear in what he says and what he believes, and we're totally on board with that. Keeping our fingers crossed and figuring that, common sense here will prevail.
Fingers crossed, common sense prevails. But in the worst case scenario, does the administration have a contingency plan in place? For instance, could we see more tariffs enacted for different sectors under Section 232?
There are various, as you know, there's 232, there's 122, there's 301. There's a variety of different sections. The Treasury Secretary yesterday mentioned he didn't want to go into the details, but he is well aware and very well prepared in the unlikely event that the case was not to go the way we wanted, that these tariffs would be put in through other avenues so as to accomplish the administration's goal, which has been incredibly popular, obviously, with financial markets, investors, American people, because, again, you're going to reindustrialize. You're employing Americans to build the factories with the foreign capital that's coming in. They're going to be employed by Americans, but there will be contingency plans put in place at some point should the court rule improperly.
Switching gears, Joe, the government shutdown is now officially the longest on record, day 37 today. Any sense of how much longer this could stretch on? And what are we dealing with as far as the economic impact so far? If this continues on much longer, what does the economic impact look to you then?
Well, the president, with Secretary Bessent's help, we've been able to pay the military. That's not going to continue. There's another payment, I believe, coming on the 15th. SNAP benefits, which people need. The Democrats are preventing us from fully giving those benefits out to folks. There's been some chatter in the news this past week, some comments that I think Leader Thune had mentioned that makes me optimistic. Maybe we can get something solved soon that some of the Democrats, some of the centrists, there are a few, will come over to our side. I mean, we don't have the 60 votes necessary to reopen the government. And that's a problem when the Democrats, who historically would support these clean continuing resolutions, it happened numerous times over numerous administrations with Republicans when they were the minority party, 15 times to be exact over the prior 4 Democratic administrations. This is the worst sort of politics. It, like I mentioned with the Supreme Court ruling, adds another layer of uncertainty. It causes businesses at the margin, Jennifer, to step back, to not commit capital. That means then less hiring, less output, less growth. CAA said we could be losing upwards of $15 billion a week. That could translate into half a point on GDP over an extended period of time, and even more if this shutdown, God forbid, were to go through the month of November when people are trying to travel and visit their families. Secretary Bessent perhaps said it best. We just need a handful of Democrats to do the right thing, be national heroes, and vote with us to reopen the government. Then we can have the discussion on some of these other things that Democrats want. But this is not the venue to close the economy down, not have hardworking men and women in our armed forces and elsewhere not get paid because of a desire to demand a vote. It's very juvenile on the Democrats' part.
And before I let you go, Joe, Secretary Bessent said over the weekend that he feels that there's a chance that parts of the economy, particularly housing, may be in recession already because of high interest rates. Is Treasury looking at taking any action, whether it comes to bill issuance or otherwise, to bring down yields and thus push down mortgage rates?
The Treasury increased bill issuance because it had to rebuild its Treasury balance, and the bill issuance now at around 20-ish% of total issuance is about in line with the historical average. I think what Secretary Bessent has made a very compelling case, and certainly this is something the president is certainly 100% in agreement with, is that his interest rates are too high. They're too high by the Fed's own admission. R-star, or the neutral rate, is well below, even now, despite Fed cuts, where the current Fed funds rate is. I am hopeful at some point that the Fed will lower rates further and realize that the tariffs, which are going to be incredibly successful in rebalancing and dealing with the current emergencies that we have, are not inflationary. They've not led to an increase in inflation expectations. The Fed should cut rates, and that in the short term will certainly help housing. And as the Secretary said, there are some sectors that are weak, and housing is one of them, and interest rates are basically the most dominant variable there.